Yeah, hello everybody. Macroeconomics today, and our topic was money. Understanding money in a modern way, or what is money today, means that we are not anymore backed up with gold or anything else, but modern money is just a promise, more or less, which we are giving to ourselves, what we because why we call it fiat money, a mixture of English and Latin. And this is more or less we are inventing money and we trust ourselves that this money has any value, so we can take it as a medium of exchange. And then we estimated that roughly the money amount which we have is more or less equal to the GDP of our monetary union in Europe. And well, that this is not very surprising. This we can derive from the quantity theory of money, which states that more or less for what do we need money? We need money to pay our goods, to exchange our goods. So we need that much money in order to pay the total amount of our goods which we are producing within 1 year. And then we derived from this quantity theory of money a money demand function, which distinguishes from the money demand function which we have derived from the different motives of money demand, that if we assume that this quantity theory of money holds, and we assume that especially the velocity of money v is only a variable which changes slowly due to the changes in the framework, due to changes of technology, that then we obtain a money demand function which is only dependent on income and which differs then from the other money demand function where we also derived a dependence on interest rates. And please keep this in mind. This is, so to speak, the classical view on money, where we have only this positive dependence on income. So we are mainly focusing on the transaction motive of holding money, and that we in this case do not have a dependence on interest rates, and that if we take this then together, that more or less we can say we have a one-to-one dependence between money increasing and price increasing, when we also assume that prices could adjust quite faster than our overall economic performance measured in Y. And from this, we had this famous statement from Milton Friedman, a very famous economist, Nobel laureate in the 1970s, and yeah, one of the representatives which this more or less strict classical view, that he said, well, if we have inflation, please look always at what the what the money is doing. So inflation is always and everywhere a monetary phenomenon. And if we really take this view very seriously, then of course we obtain this split between real variables and nominal variables. And this I also quite often mentioned within this lecture that in the end, what matters is not that we have 1,000 or 2,000 euros per month in order to spend it for some goods, but how much goods we can buy with 2,000 euros, for example. And this, of course, depends highly what is the price level or where are the prices in the future are going. So this depends on inflation. And yeah, this is then, so to speak, the point between two main, in their assumptions, quite opposite views of on the economy, how it works. There's one view which states, well, prices could not that fast adjust if anything changes in the economy. So this then would mean if we have an additional 500 euros in our pocket, then we would say, well, if prices don't change, what are we doing? If we assume that we have normal goods, remember your microcurse, then we start to consume with these 500 euros. And the other view is, well, if we increase just our income by printing money, and these 500 euros come from only printed money, fiat money, then we assume that prices directly adjust and that we can buy as much goods now with 2,500 euros compared to the history, the 2,000 euros, and that we cannot buy more goods because now everything is more expensive. And so to speak, this is one of the crucial assumptions. How fast can prices adjust? And this we will later on see when we are discussing then economic theories. Okay, but now let's go on. Where now does the money come from within our economy? Of course, more or less, we can say we are start to print money, and there we have a central institution, the central bank, with which has the right to print the monies. And of course, although it is a central bank, a special institution within our country, within our economy, it is still just a bank, and therefore this bank has, of course, also a balance sheet split into assets and liabilities. And on the liability side, we just have the printed money, currency in circulation, the euros which we find in our pockets. Then, within our economy, we also say that every bank has to make a deposit at the central bank. This is some kind of insurance. We see this was a long-term 2% of the balance sheet, and now it is only 1%. We will talk about this, and this is called the so-called minimum reserve. And then there are also other liabilities, especially all members of the European Monetary Union. They have, of course, some equity. This is roughly, I think, 10 billion euros. It is not that much, but this is the liability side. And then on the other side, of course, the central bank holds foreign money, especially we don't have the anchor currency in the world, so the ECB holds a lot of US dollar. Then, especially during the financial crisis and in the aftermath of the financial crisis, the central bank give credits to the domestic banking sector. And then, of course, we have also other assets also within in the aftermath of the financial crisis. The central bank starts to buy assets at the private markets, and we will talk about this also later. And so, to speak in the end, we can say that the balance sheet is, so to speak, the monetary base. But then, this is not the end. Remember when we were defining M1, M2, M3? And think of yourself. We are not paying only with cash money. It is even, the situation is even now so that we pay much more often just with our banking card, with our banking account, with a credit card, with our PayPal account. You can pay within Amazon and so on. And this means there is also a money creation via the commercial banks. And how does this function? Think of a commercial bank. A commercial bank obtains deposits from their customers. So we are deciding, think of the circular flow. We are deciding what shall we do with our income. We split it. Roughly 90% we consume in Germany and 10% roughly we are saving. So with this 10% saving, we are going to our private bank and make a deposit. So what is the function of the commercial banks? We have talked about this already. They take all these small savings together and they give out credits to other customers. Think in the private, in the household sector, you need a credit in order to buy a house or a flat or something. Or then, of course, also think of some enterprise which want to make an investment and they do not have that much equity that they can finance it by itself. Then they ask their bank, well, I want to expand. I need new machines. I need a new factory. I want to invest 10 million euros. Well, what happens then? Then I get a credit, and now we assume that the household or the enterprise which obtains the credit has another private bank than myself. So I get the credit, and what happens is at another bank, there appears another deposit due to the credit which the enterprise or the household has obtained. Well, and in general, by law, the commercial bank is not allowed to give out all its money, all its deposits. There is a law that you have to hold a minimum reserve. Why is it? Well, the reason for this is if I have a banking account, if I have made a deposit, then maybe not today and not tomorrow I want to use the money, but let's say next week. Then I go to the bank and ask, well, I have a deposit of 2,000 euros. I want to have 500 euros out of my deposit. And if now the total amount of deposits would have given away, then the private bank could not pay me although I own this money. Well, and the assumption is that not everybody is going simultaneously to the bank. We make our deposits for a longer period. And therefore, it is possible that the private bank gives partially its deposits away for credits. And even this is the function of the financial system of our commercial banks, but not 100%, because then it would be highly risky. Because if somebody then comes there and he announces, well, I have a deposit, but I don't get my money, what will happen if this news feeds in through the society? Everybody is directly walking to the bank, and this we call a bank run. And if too many people simultaneously come to the bank and ask for their money, then it could happen that this bank breaks down. So let's make an example. Let's say commercial bank 1 holds 1 million euros. And from this total amount of deposits, the first bank gives away a credit volume of 90% of these 1 million euros. So assuming a reserve ratio of 10%. Do I have a, yes, here I have it. So starting point, bank 1, deposit of 1 million euros and reserve ratio of 10%. Credit of, let's call this R, capital R, 1 minus R times 1 million euro equals 90% times 1 million euro equals 900,000 euros. This is given away as a credit to a private customer. And now we assume that this private customer has a banking account at another bank. So at bank 2, we see a deposit of 900,000 euros. And this bank should have the same reserve ratio. What happens then? Maybe you can answer me this question. Since we are now only online, you can also use the microphone. So in the second round, we have at bank 2 a deposit of 900,000 euros, the same reserve ratio. How much credit is this bank giving away? $810. Great. So credit of 1 minus 10% times 900,000 euros equals 810,000 euros. Again, we assume this credit amount is given to some private customer. This private customer has again another relationship to a private bank, bank 3, and there we would have then bank 3 a deposit of 810,000 euros. And this would mean how much credit would this bank give into the system? Again, we assume the same ratio, 729. Great. So 1 minus 10% times 810,000 euros equals 729,000 euros. Well, and this process goes on and on and on. Well, and now we can say that all these deposits together represent money. Because why? Well, if you think you are the first customer with the 1 million, then you are going out and you are deciding about your what you are doing, that you have in mind. Well, I have at my banking account 1 million euro. The next one has obtained a credit of 900,000. And so he handles also his money having 900,000 euros. The next one, 810, 729, and so on and so on. Because everybody has this money at his private bank. So then total money in the system equals the sum of all deposits. What does this mean? We have to sum up all this. So M would be 1 million plus 900,000 plus 810,000 plus 729,000 plus, and so on and so on and so on. And what will be the result of this? We are adding up an infinite number of money amounts. And hopefully you have seen a series like this already in school and of course in your mathematics course, and maybe if you have already an investment lecture, or also I think within some accounting course, you should also have seen a series like this. Does anybody know how I can calculate the sum of such a series? Or what is this called, this series? Any idea? Because within these numbers, always we find this same reserve ratio. So then let me show you how we also can rewrite this sum. And now I just write here 1,000 for 1 million, 1,000 euros, so to speak, plus the 900. Where does it come from? It comes from 1 minus r times 1 million, so 0.9 times 1,000. The 810 came from 0.9 times 900, this one, so 0.9 squared times 1,000. And the next one, 0.9 to the power of 3 times 1,000. So what we can do now is we can take out of brackets this 1,000 times 1 plus 0.9 plus 0.9 squared plus 0.9 to the power of 3 plus up to infinity. And now hopefully somebody of you can say me how we call such a series. I think you definitely have seen it in school and in your mathematics course, and I think also in an investment course or something else. This is called a geometric series. Anybody has heard this name? Because if we go to nature and of course also in economics, geometric series you very often find if we are describing growth processes. And this is nothing else like a growth process. It is a growth process of money, how this way of money creation in the private banking sector is feeding through the system. And for this geometric series, you have shown in school that although we are adding up an infinite number of numbers, this is still a finite number in the end. So geometric series, let me remember you. This is just 1 plus q squared plus q3 and so on, or written with a summation operator. Oops. There we are. Here we are. Q to n equals 0 to infinity is 1 over 1 minus q, and q absolute value has to be smaller than 1. Well, this also we can motivate. Let's say q equals 1/2. Then we would start with a 1, and let's say we start with a quadrant of length 1. Then the area, starting area is 1. And if we sum up now, always taking half of it, what would it mean? We would start with the square. Then we add half of the square. This is 1/2. Then we add half of half. So this would be this, 1/4. Then we are dividing this, this one, this, and this, and this, and this, and so on. And then I think you can imagine, what do we additionally to our starting square obtain? We just obtain another square, going to infinity, taking always the half. And if you put in this, q equals 1/2, this is 1 minus 1 minus a half, is 1 over 1/2 is 2, is just the area of 2 squares. So here, then we could write 1000 times 1 over 1 minus 0.9 is 1 over 0.1 times 1000 is 10 million euros. So what we have done, we have created out of 1 million via the private banking sector another 9 million euros. So we more or less multiplied our starting deposits by this factor 1 over 0.1. And in general, we can, of course, do this calculation not taking directly the 10%, but asking ourselves what would be the multiplication effect with any reserve ratio. Then we would obtain 1000 times 1 over 1 minus, and now be careful. How did we obtain the 0.9? We obtained it by 1 minus the reserve ratio. So 1 minus R equals the monetary base times, and this then cancels, 1 over R. So this is then the money multiplier. This is, so to speak, our monetary 1 million base. And this is then leveled by 1 over the reserve ratio. And not very surprisingly, the less the reserve ratio, the larger the level. So money is leveled by 1 over the reserve ratio. Okay, so this is then called the money creation process via the financial system. Here I gave this to you also in a general way, and here you also see the geometric series And please keep this geometric series in mind because later on we will use it. This process we will use again. Yeah, let's now go to the monetary policy of the ECB. And this is just a revision. We had this when we had the magic square, the system of aims in our economy. So the governing council of the ECB considers price stability at an inflation rate of 2% measured by the relative change of the harmonized index of consumer prices. What this is, consumer price index, we also have already talked about, and also that we have not a point for the aim of 2%, but that we say in the medium run we want to achieve 2%. So we allow for some volatility around 2%, and this allowance for for volatility around 2% should be symmetric. So we can have higher inflation rates than 2% and lower ones, and this actually has changed just in 2019, beforehand the Corona crisis. Before that, we just say, well, also we have 2%, but we do not want to have inflation rates higher than 2%. Yeah, and now what kind of instruments do we have in our system? And for this, again, remember this minimum reserve requirement. We have a law that every commercial bank has to hold central bank money. So in every month, every commercial bank is calculating their balance sheet, what kind of assets they have, and due to this, they need a specific ratio of central money. And for this, every month, the commercial banks apply at the central bank for central bank money, and then they obtain this money for a special interest rate, and this is the so-called main refinancing operations. And the interest rate for these main refinancing operations, this is called the key interest rate. Maybe we change this also, that you know this. If we are talking about key interest rates within a monetary union or within a country which has its own currency, then this is called the key interest rate. Well, and then we can think of, if the portfolio managers in the bank always, yeah, make a very good job and they really obtained that amount of central bank money that they need, then everything would be fine. But of course, economy is volatile, and therefore it could be the case that the commercial bank has done more money still in their deposits, and they don't know what they should do. Think about also in the aftermath of the financial crisis that we have a very unsecure situation, and maybe this we will have in the next years due to the polls in the United States and due to the insecureness because of the end of the coalition in Germany. that a commercial bank do not want to give away their money to another bank, then they always have the possibility to give their money for a lower interest rate compared to the main refinancing operation interest rate, to the key interest rate, to the central bank. And this is called the deposit facility. And on the other side, maybe the portfolio management within the private bank has miscalculated and they need even more central bank money. Then they have the opportunity to obtain central bank money out of the process of the main refinancing operations, so every day, so to speak, for a higher interest rate from the central bank, and this is called the marginal lending facility. And usually, of course, a commercial bank could in general also go to its neighbor private bank to obtain additional money. But sometimes, if there are some news in the economy that maybe a bank has a problem, then it has to go to the central bank because no other neighbor private bank gives them money. And this situation was dramatically in the financial crisis. And there we have seen in this marginal lending facilities triple digit billions of euros. Right now, it came really down again, but let's see where our economy, especially in Europe, is going in the next month or years. So, and these we then call classical instruments of our central bank. This we have always. And of course, another classical instrument we have already talked about is the minimum reserve requirement. And right now it is 1%. And there we say, well, somehow you can understand this like an endurance that we say in order that our financial system has some stability, we do not allow that commercial banks give 100% of their liabilities away, that they still need to have a minimum reserve, and this is right now 1% of the balance sheet in the European monetary system. And yeah, with this key interest rate, in general, a central bank is steering the interest rate level within the financial system. But we see here, this is very short time. So directly, the central bank can influence with this key interest rate only the short-term interest rate. And so to speak, the aim of the central bank is to steer a specific short-term interest rate of the financial system, and this is called the Euro short-term rate. This is the short-term rate of the private banks. With this interest rate, the private banks are interchanging money to each other. So this interest rate represents the overnight interbank interest rate. So and now, how is this short-term interest rate feeding through the whole maturities to 1 year, 2 year, up to 30 years within the system, well, we can say if the central bank is reducing key interest rate, then this has a direct impact on the short-term interest rate. So ESTR, this is going down. So what will be the impact on the financial agents? Well, they see my short-term investments, they are going down in the yield. What I will do is I start to shift in my portfolio my investments from short-term investments to longer-term investments. But if this process starts, so demand for longer-term bonds increases, this would mean that the value of this bond increases, but this dampens, of course, the yield of the bonds because now demand increasing, think of an outward shift of our demand curve. I have to pay a higher price now for longer term bonds. Think of a coupon of 3% or something, but I have now had to buy the bond not for 100, but 101. So my yield, since I have to buy it for a higher price, comes down. So prices of longer term bonds increase, and therefore we have an adjustment of also longer term interest rates of the longer maturities downward, starting from the point that the key interest rates have been lowered. But on this dependence in general, that there is not one interest rate in our economy. Later on in our um, theoretical models, we will always call only about this specific interest rate within an economy. But in general, of course, we have different maturities, and therefore, in general, we find interest rate maturity measured in time, 1, 2, in general, it is years, and numbers in general in developed countries you find up to 30 years, that we have a dependence between interest rate and maturity. And we come to this in a minute, that in general, we would expect that the longer the maturity, the higher would be the interest rate. But before we come to this, let's just think of how a change in interest rate is feeding through our economy. So again, we can think of central bank is cutting interest rates. What does this mean? A drop in interest rates makes a credit cheaper. Think again of it. The interest rate is, so to speak, the price of the credit. Well, if it's now easier for me to get any credit, then it's easier to me to to finance in general investment and consumptions via credits. But this then means we have an increase of demands for investment goods and consumption goods. So the utilization of production will increase because of the higher demand. And this will push economic growth. But then think of potential output and the business cycle. When we increase demand, producing more, at some time, we come to the limit of capacity. And there, business cycle, then we come to a situation where we start to stagnate. We cannot produce much more in our economy. And so, especially since cost will increase, we expect that profits will even fall. And so, if we still lower interest rates, then this could not start anymore a higher utilization of production because we're already at the limit. So we cannot increase investment anymore. And what then could happen, and this is, so to speak, then the change in the view here in the starting point, prices, argumentation, in this argumentation, prices did not adjust. But if it's not anymore possible to increase quantity, then of course the firms and enterprises would do what? Well, they see there is more liquidity in the market, then I can just increase my prices. And in the end, pushing liquidity will then end up in an increase of prices. And this is then the argumentation via quantity theory of money. Or we can also do this indirectly. Now we look at the financial markets in between. Again, interest rate cut. Then we have argued that this feeds through the system, that the yields of the bonds will decline. Yield curve, 1 minute ago. And now think in alternatives. We have the alternative to invest in bonds or in stocks. For bonds, we obtain a definite interest rate. Stocks are more risky. I don't know where the stocks market is tomorrow. But on average, if the bond interest rates goes down, then it will be more interesting, more attractive for me to invest in stocks. So stocks will go up. Increase of stock prices. Well, and if we have a fully functioning market, then this process will happen as long as the yield of the stock market equals in the end the lower yield at the bond market. But what does it mean? If the prices at the capital market has increased, then also the owners of the stocks will have a higher income due to the higher prices of the stock markets. And then again, our general assumption, what does a higher income for an economic agent means? Higher income will mean higher consumption and higher investment plans. And then higher consumption, higher investment plans, we are again here. Then we can add this argumentation from the former slide. Again, limit of capacity and in the end, is more lowering interest rate, so pushing liquidity would end up then in inflation. So, and the last thing I want to talk to you today now is about, the yield curve, which I have introduced here, the dependence between interest rate and maturity. And now we want to argue, why is it possible that interest rates for different, you still hear me? Yes, okay, works now. I think my picture will be gone now. Yeah, but this doesn't matter because the video is still recording. Okay, but you cannot see me anymore. Sorry for this. Okay, so we want to talk, why are falling these interest rates apart? And for this, we have different explanations, and one is the so-called market expectation theory. And this is a very powerful instrument also to explain what happens within economy. So think of, we have a low short-term interest rate, 1 year of 2%, and a high long-term interest rate, long-term, we say here now 2 years at 4%. And now we make the assumptions that short-term and long-term investments are perfect substitutes. And our investors are risk neutral, so they do not think about to distinguish these two investments, that we say, well, in one time I'm giving away my money for 2 years, and the other time no, only at for 1 year, and that we have perfect capital markets. So at any time I can get any amount of credit, and at any time, and I could make an investment in every possible maturity. So what does this would mean if we make these assumptions? Then, of course, in equilibrium, the yields of a short-term investment have to meet the yield of a long-term investment. So in equilibrium, yield of short-term investment has to meet the yield of long-term investment. But in order to compare the two investments, we cannot directly compare 2 and 4 because they are differing in the maturity. So in order to compare the two investments, we have to compare two investments which last both 2 years. And let's say we start with an investment of €1. Long term, what happens? I take the €1, invest it 2 years at 4%. This means 1 plus 4% times 1 plus 4% after 2 years. So first year, second year. What is the outcome when I'm investing short term, I take my €1 times 1 plus 2%. And now, in order to have the same maturity, I can say also, assuming perfect capital markets, that in 1 year, I have also the possibility to invest my money an additional year. So investing in 1 year for 1 year means that then I can invest for an expected short-term interest rate. Well, of course, I don't know where are the interest rates tomorrow. So after 2 years, I would have then 1 plus I1E, the expected short-term interest rate. In 1 year. And making all these assumptions here, perfect substitutes, risk neutral, I don't care that the one is short term, the other one is long term. This means in equilibrium, these has to be the same. And this is the so-called no arbitrage condition. Or sometimes it's called no free lunch. What is it called? If these would differ and I have capital markets, then I could take a credit for the lower yield, consuming or buying then the investment with a higher yield. And the difference of the yields would then be my free lunch. But in perfect markets, then I would assume that, of course, if one yield is lower than the other, the demand for the higher yield increases, and this will dampen the higher yield until we have this equality sign. Well, if we have this equality sign, what happens then? Let's do this in red. Oh, this is a bit large. This one. On both sides, we have €1. This cancels. Then let's multiply the brackets. 1 plus 2% plus 1 IE plus 2% times 1 IE equals 1 plus 2% plus 4%, sorry, plus 4% times 4% squared. Also, this one cancels. And now remember our Fisher equation, where we have set the approximation of the definite Fisher equation, real interest rates, nominal interest rates, inflation, together, that we come to nominal interest rates minus inflation equals real interest rates. There we said this we can do if our interest rates and inflation lower than 10%. And this assumption we now also make, because again, if we have here two numbers smaller than 10% or the 4% is smaller than 10%, 0.4 times 0.4 is 0.0016. So it's much less than the 4% itself. So this we can then approximately leave out for numbers lower than 10%. And what do we obtain then? Then we obtain 1 IE equals 4% plus 4% minus 2% if we are subtracting on both sides the 2%. And we end up 4 plus 4 minus 2 equals 6%. So financial markets expect an increase of short-term interest rates. Because why? Well, all these interest rates for different bonds with different maturities, we can look up today. So we are knowing these two numbers, 2 and 4%. And this is a very nice situation for economists because from our theory, market expectation theory, now we can derive a parameter in the future depending on known parameters today. So this is then an instrument of forecast because we can look up the today's market conditions due to the yield curve, and from this we can calculate the market expectation for short-term interest rates tomorrow. And we can even more interpret here. We see within this situation when long-term interest rates are higher than short-term interest rates, in general, we find that the market expects higher short-term interest rates in the future. Well, but we are knowing that the central bank is steering short-term interest rates. So this would then also mean market expects an interest rate, an increase of short-term of key, so to speak, because we are steering short-term interest rates of key interest rates. Well, and when do we expect that central bank is increasing key interest rates? Well, in a situation when we want to lower growth, because then credits will become more expensive. So within the business cycle, we would then expect that we are somehow in the part of expansion or in a boom. Then within the business cycle, we are in expansion or boom. Well, this would be a quite nice situation, but we can also say, and this we take then in green, but the opposite also holds. And what does this mean? If I1 is larger than I2, short-term interest rates are higher than long-term interest rates, then the market would expect a lowering in short-term interest rates. So the market expect that the central bank is decreasing interest rates, and this is then an indicator for a crisis. This would mean lower key interest rates in the future, and though the market is expecting a crisis. And so we can say that this yield curve is an indicator for a crisis tomorrow. And to end today, in the forehand of every crisis since World War II, we always have seen that short-term interest rates have been higher than long-term interest rates, and this we call a so-called inversion of the yield curve. So this is a very, very powerful instrument, because always if we see this inversion of the yield curve, then we really can say, well, be very careful. There maybe happens something bad in the future. Okay, so thank you very much for today, and let's see on Thursday.